Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialist, Oriane Parmentier.
Hello.
And Deepika, Dayal.
Hello.
Okay, so we're recording this with the Middle East very much back in focus. We've had reports of renewed strikes over the last sort of 24, 48 hours. Comments from Trump suggesting that the ceasefire has been broken. We've had oil prices up off the recent lows, and markets are again reassessing central bank pricing and the possibility of rate hikes later this year. So perhaps that is the best place to start. Oriane, I'm going to start with you because I think that the ECB's reaction function in some ways has perhaps been the clearest through this war so far. They hiked and they were clear about their intentions to do so should oil prices remain elevated to avoid inflation expectations becoming de-anchored. So I suppose through that lens, the higher oil prices remain for longer, it feels like the more likely the ECB is to hike again versus what was our previous base case just a couple of days ago. So does this change how you're thinking about the upcoming July meeting for the ECB?
Yeah, so I would say the reaction to the latest Iran headlines has been pretty strong. We saw rate markets immediately starting to reprice the ECB outlook, and swaps were pricing at some point around 40 basis points of additional tightening for this year, compared with roughly 25, 27 basis points earlier in the week. I think some repricing is perfectly understandable given the situation. Geopolitical risks have gone up, and energy is obviously the transmission channel the ECB worries about most. But I do think the move-in rate has been somewhat aggressive, perhaps, to what we actually know. So energy prices have risen, but the repricing has still been, I would say, still relatively contained. There is also a realistic chance that this proves to be a relatively short-lived episode as well. Trump's rhetoric has been tough, but he has also not completely shut the door to further negotiations and suggested that the conflict could end fairly quickly as well. So while geopolitical risks have clearly returned to the forefront, it's not yet obvious that we are looking at a prolonged energy shock at this stage. And I think it was fair to assume that the path to a resolution of the conflict also wasn't going to be perfectly linear. So for the ECB, I will also say that the question isn't just about where oil prices are today. It's also whether this evolves into a genuine supply disruption. That is why the Strait of Hormuz is obviously so important. So the ECB can still probably afford to look through some near-term volatility, and I think it's perhaps too early to say whether this episode is big enough to fundamentally change the policy outlook. Of course, we've seen this week some of the ECB's hawkish voices respond. Nigel, for example, said we couldn't rule out further rate hikes from the ECB, and he reiterated the need for a meeting-by-meeting approach. That is not especially surprising. Hawks tend to react quickly when there is a risk of higher inflation. And there is another point here, I think, when central banks face geopolitical shocks, they don't have many tools available. Communication clearly is one of the most important ones. So the ECB needs to keep inflation expectation anchored. So it has every incentive, I think, to remind markets that it remains willing to act if necessary. In other words, policymakers need to preserve optionality, even if the base case eventually remains one of staying on hold. So looking at July specifically, I wouldn't say much has changed in the sense that the meeting simply comes too soon. The Governing Council won't have enough information to judge whether this is a temporary, renewed shock, if it is the start of something more persistent. But crucially as well, they won't even have the July inflation data, at hand for the meeting. So from that perspective, July I think effectively should be off the table. September is where the conversation becomes more interesting. Obviously, by then we will have a much clearer picture of whether these intentions had, faded, if there has been a more durable sources of inflation pressure. But I think here it's worth remembering that the underlying inflation backdrop had actually been moving in the right direction. Medium-term inflation expectations have remained well anchored. The June inflation print surprised slightly to the downside. Wage indicators have, somewhat continue to soften, and more importantly, I think we've seen very limited evidence of second round effects. On that note, we just got the ECB minutes this week. They did note that some indirect effects from earlier energy shocks may still be filtering through the economy. But I think there is an important distinction to make here. Indirect effects are not the same thing as second round effects. Some pass-through from higher input costs is probably inevitable, but what should really matter for monetary policy is whether higher energy prices start feeding into wages and create a broader inflation cycle. And so far, there is very little sign of that happening. So putting it together, I would be inclined to fade some of the recent repricing in euro rates. Of course, there is a scenario where the situation deteriorates significantly and, energy supplies are disrupted. And if that happens, the ECB conversation changes. But based on what we know today, it probably feels a little bit premature to conclude that the ECB's reaction function has shifted materially, or that another hike has become the central scenario for markets, I'd say. Right, Deepika, how about for you? We've had a hawkish Fed meeting in June, and minutes from the Fed meeting published this week that suggested some members saw a case for a hike in June. But then data since hasn't suggested any urgencies to hike. How do you think spot oil prices might complicate the picture in July?
Right. So you're right, Orion. The movements in oil prices naturally create some amount of uncertainty for the Fed and the economy as a whole. But what we learned from the minutes on Wednesday was that there weren't any new insights that the committee really wanted to offer to market participants beyond what they had given on June 16, 17 with the FOMC meeting. The minutes effectively showed a committee willing to wait and watch at the moment, but ready to act in either direction with possible hikes in case inflationary pressures turn out to be more persistent, or even be open to cuts if inflation begins to make progress towards the 2% objective. In fact, there was a lot more conversation around the AI related angle to inflation coming down over time. Of course, that being noted, these minutes and the June FOMC meeting itself predated the climb higher in oil prices that we've seen over the past 48 hours. But at the same time, the data that they have and may see in the coming week up until the July meeting would probably warrant a more patient approach than just reacting to what's happening to oil prices in the short term. We did see the employment report for the month of June come out after the June FOMC meeting, and that showed a break-even like pace of job growth of about 57,000 in June. That does suggest that this narrative of the labor market re-accelerating again may require a little more of a rethink, and a few more prints may be needed before uh, the verdict that the labor market is really out of the woods. And in addition to that, the upcoming week will also bring in the June set of inflation data on CPI and PPI. This will be the latest set of inflation data available to the Fed. And we do see, at least optically, that would allow the Fed and most committee members to sort of stay patient and continue to see how things spill out. For what it's worth, we're looking for a 0.2% drop on the headline CPI in the upcoming week and a flat reading on the headline PPI. We are also expecting a sort of a tame core CPI reading of a 0.2% uptick there. That's the same that we saw in May. And despite some energy related price pressures in isolated pockets within the core number, we do think in general the core CPI is still not showing signs of broad-based spillover from the energy shock that we've seen over the last 3 months. So from that perspective, I do think that committee members may be willing to see how these gyrations in the oil prices kind of play out over the coming months before really committing to any rate path.
You talked then about the data that we get, between now and the next Fed meeting, but obviously we have quite strong views on how the data is going to evolve in the coming months to get to our kind of ultimately more dovish Fed view that we have and thinking that they will eventually cut rates in 2027. So can you comment more broadly on how you see that data evolving over the coming months and how worried are you about a reacceleration of inflation in the US?
Yes, absolutely. So our expectation remains that these higher oil prices turn out to be a double-edged sword, which could push up prices initially, but then eventually it weighs as a tax on the consumer and sort of curtails growth momentum in the economy. For what it's worth, we did see a little bit of that with the employment report in June, and some of the more reliable leading indicators for the employment data, such as the NFIB's hiring intentions index, suggests that businesses are still facing a little bit of uncertainty around their hiring plans. And if that does come to fruition, we could see consumption growth sort of slowing down, even with perhaps some but limited spillovers from oil prices to core inflation. So our forecasts right now call for the unemployment rate to tick higher to about 4.4 by the end of this year and climb higher to about 4.6 around the turn of the year. And the economic growth momentum to slow down to about a quarterly annualized pace of 1.5% in the second half. And this is despite factoring in the boost from AI related capex that we've seen over the past couple of quarters. And not just on the on the economy side, even with the inflation picture, we think there are some tailwinds that could sort of help mitigate some of the acceleration that we may get from oil prices and inflation. For one, a good portion of the tariff pass through we think is done. And with tariff refunds sort of helping businesses mitigate some of these higher costs, we think the net pass through from these higher oil prices may be a bit limited. Then there are other tailwinds such as slowing rents, slowing insurance rates. Now, these components are also a reflection of how the BLS measures the CPI or inflation in general. However, we do see that these could help to offset some of the price pressures that we're seeing just by virtue of higher oil prices over the last few months. For what it's worth, we do see core PCE inflation coming down from 3.3% year on year in Q2 to about 3.1. And in fact, by September, we think we could be seeing a lower trajectory of inflation that has been reported so far. We talked about this in a recent note, and it looks like some of the methodological changes that the BEA will implement over with the annual benchmark revisions in late September could actually show a lower inflation trajectory on just core PCE than what's been reported right now, which would again possibly allow the Fed to stay on hold and see how um, the oil impact really plays out. So at this point, we're not looking for much of a reacceleration in core inflation. In fact, this morning, New York Fed President Williams also had similar thoughts, and he said that it's reasonable to see the impact of these higher prices being muted by some of these factors we talked about. On that note, Imogen, what about in the UK? That's where we see the clearest risk of a higher policy rate at the end of the year. Is that still the case?
Yeah, so regular listeners will know that we've long been at the more hawkish end of the spectrum when it comes to our Bank of England views. And that's not always more hawkish than market pricing, but I think as we've discussed frequently in recent podcasts, there has consistently over the last couple of months been this disconnect between what consensus views for the Bank of England actually are and the way that the market is pricing the policy path in the months ahead. But nonetheless, we changed our call pretty early on in the conflict for 2 rate hikes from the Bank of England, one in Q4 and one in Q1. And we've kept it there ever since. We've always had this view that, whilst we've not always been that far from market pricing in terms of cumulative tightening that's going to be delivered, we've long been of the view that rate hikes are going to come later rather than earlier. So I think if anything at the margin, then obviously this week's events, higher oil prices kind of reinforce the case or the eventual need for policy tightening. But that doesn't necessarily mean that it reinforces the case for very near-term meetings. The BOE has been quite clear what its reaction function is. And, as we've heard, it's different to that of the ECB, probably different to that of the Fed as well. And that majority 7 that have still been voting for unchanged rates have been clear that they want to see evidence of second round effects before raising rates. And whilst we think that the evidence will be there, particularly as we enter the kind of 2027 wage negotiation period. And of course, higher oil prices for longer and more disruption in the Middle East suggests a greater risk of those second round effects. I think the July meeting and maybe even the September meeting are still too early to be able to assess the kind of persistence of these inflationary pressures. So at the margin, I suppose it reinforces our conviction around a more hawkish bank rate view, but it certainly doesn't move the needle in terms of when we would expect those rate hikes. And, we already had this more hawkish view, so it's not like it's changed the view. It just sort of marginally reinforces the conviction. But one thing I think is quite important when we reflect about the way that, this week's events might influence market pricing is, we've had this more hawkish view on bank rate, and partly as a result of that and partly because of other things, particularly the political backdrop that we've discussed again here many times before, we've had this also more bearish view on gilt yields. We've been expecting gilt yields to rise above current levels for quite a long time. And sometimes the pushback that I get on that view is that bank rate pricing had a lot further to adjust in a more dovish direction because true consensus was a lot more dovish than market pricing. Consensus was really for rate cuts rather than rate hikes and still is. And therefore, if market pricing is going to adjust much more closely to that kind of consensus view, that will cap how high yields can rise. I always thought that was a bit of a misjudgment because one of the reasons for that market pricing for bank rate wasn't moving lower was because it reflects a probability weighted outcome rather than pure expectations of the policy path. And those risks were still skewed to the upside. So it was natural that you would get this kind of positive spread, if you like, between market pricing for bank rate and where consensus views were. But this week's events just reinforce those upside risks. It reinforces the fact that maybe oil prices back at pre-war lows wasn't a fair reflection of the premium that should have been embedded for the potential for things like a negotiation breakdown of the ceasefire to occur. And whilst risks are skewed to the upside, it's going to be hard for the market pricing to adjust materially any lower, even if it hasn't kind of changed the underlying consensus view that bank rate won't rise. So if anything, it sort of reinforces our view around bank rate, but also reinforces to me the kind of bearish risks for longer dated yields as well, and reinforces this view that we can get back up to 5.25 and 10-year gilt yields. But perhaps that leads us nicely onto our next conversation, because politics has, of course, been in focus. It remains in focus in the UK, but it's also been in focus in the Euro area. We've had some news out of France this week. So, Oriane, can you update us on what we've learned this week?
Yes, of course. So the big story in France is that Marine Le Pen, who is the far-right party's leader, has confirmed she intends to run in the 2027 presidential election, despite her conviction for embezzling EU funds. I think her strategy is relatively straightforward here. She is appealing to the Cour de Cassation, which is the highest court of justice in France, and she appears to be betting that the legal process will take long enough for her to campaign and potentially even run in the election before any final ruling is enforced. Going into this week, I think the consensus view was perhaps more than that Le Pen would eventually step aside, clearing the way for Jordan Bardella to become the far-right party, the Rassemblement National candidate. And if you looked at polls, Bardella actually had a slight edge in the first round voting intention, but both candidates were comfortably leading the field and looking, well placed to qualify for the runoff. I think Le Pen was always the more experienced politician. She's fought multiple presidential campaigns now. She's clearly battle-tested and arguably, I think in that sense, carries a lower risk of a campaign mistake. And obviously, polls were not capturing that. So in that sense, absent the conviction, I would have seen her as a stronger candidate than Bardella. But it's also notable, I think, that so far there's been very little evidence that the conviction has actually damaged her support for her or, for her party more broadly. Many voters appear to separate her legal issues from the party's political appeal. And I think Le Pen herself has already been trying to turn the issue into a political argument as well. So framing it as a question of democratic legitimacy and presenting herself as someone who is being treated unfairly by institutions. I think that may resonate well with part of her electorate, but ultimately I also think that a conviction is more likely to be a drag than a benefit once the campaign really gets underway. I think it's difficult to see how a criminal conviction broadens a candidate's appeal beyond her existing base. And if the courts were to confirm the ruling during the campaign, or indeed after an election victory, that would create significant political complications as well. So quite an unprecedented situation in French politics here, I would say.
And what does that really mean from a market's perspective? I guess thinking about it near term, as in what does it mean for the next couple of weeks, but also longer term, we've got, well, as you've alluded to, we've got the French elections coming up in 2027. Before then, we've got budget season. So there are a couple of risk events on the horizon for OATs.
Yes, of course. So we've seen that OATs have come under some pressure recently. Part of that reflects, of course, the broader risk of move linked to the developments in the Middle East. But we've also seen underperformance versus other European government bond markets. And I think, the obvious reason for that is that Marine Le Pen is generally viewed as a less market-friendly candidate than Jordan Bardella. And while I think the gap between the two shouldn't be overstated, investors really have tended to see Bardella as the more pragmatic and business-friendly figure compared to Le Pen. I think she also carries some Eurosceptic baggage as well, which can make markets a little bit more cautious. But I would say I don't think that the Le Pen versus Bardella question is something markets should have been aggressively, pricing or caring about. Clearly, I think what happened here is that the headlines have revived the perceived risk around the French election next year. But I would say it is arguably also quite early for that. The national rally, so Marine Le Pen's party, won't formally launch the presidential campaign until end of October, it seems. The election itself is still some way off. And there are a lot of moving parts as well. I think Le Pen's legal troubles create a lot of uncertainty. There is a clear fragmentation of candidates in the center, and I don't expect a consolidation before later in the year. So I think these are forces that are kind of like pulling in different directions, and it makes it perhaps difficult for market to take a strong view at this stage. We have clearly seen a pickup in investors' interest on France in the past weeks. So we've met international investors in London last month. I think most seem relatively comfortable carrying French risks through the summer, and even some into the budget season, actually. Domestic investors in Paris that we saw recently were quite noticeably more cautious, I would say, particularly around the fiscal outlook and the budget negotiations ahead. But it's been also a fairly consistent pattern over the last couple of years. French investors have been generally more pessimistic on domestic political risk than international investors, I found. And as far as I would say, for now, we struggle to identify a clear catalyst for a significant widening in equity spreads over the summer on domestic news at these levels. Of course, in the near term, the Middle East situation dictates the direction of travel for country spreads. But looking at France in the EGB world, valuation look locally cheap. And it's not clear for me, as I said, that the political risk premium should have increased that much that early as well. Looking ahead, we do think that the presidential election is likely to become a much more important market story, but it's probably one for later this year and into perhaps potentially even early next year. In the meantime, if the situation in the Middle East de-escalates, I think being short France can actually prove to be a painful trade at already wide levels as well. Right, Imogen, politics is obviously an important theme still in the UK. What are you watching out for at the moment?
Yeah, it's still a theme. There's lots of headlines, but it's not driving much market moves, I would say. We're in this phase now where the Parliamentary Labour Party nominations are open for the next leader of the Labour Party and therefore the next Prime Minister. It feels unlikely that anybody except for Andy Burnham is going to be part of this contest, and therefore it will be a coronation rather than a contest, albeit this won't be confirmed until next week once nominations are closed. But it should be evident, we think, by the end of next week if Andy Burnham is going to be Prime Minister. That in and of itself doesn't mean very much for markets. It's the very much expected outcome at this stage and very much priced in. What we still don't think is priced in are the risks around borrowing, the risks around the extent to which we think a new government will bring increases in borrowing, despite Andy Burnham's apparent commitment to fiscal discipline in his speaking engagements in the last couple of weeks. I think it's going to take more than just whether it be the coronation or a contest, but it's going to take more than just a change in Prime Minister for markets to adjust to those risks. The appointment of the Chancellor could be the first moment. Of course, it depends who it is and where they are perceived to sit on the political spectrum. But, if Andy Burnham does up for someone that's considered to be a bit more left-wing, then that could be a moment for markets to reassess what really his intentions are around fiscal policy. But perhaps more importantly, it will become clearer through the summer. We'll likely get some sort of policy ideas being floated through the summer with risks centred I think more closely around the party conference, when we'll probably get specifics around policy priorities. That will be at the end of September. And then very shortly after, the first fiscal event in the autumn, where we will, of course, get the specific costings of any policy announcement. So we're in this kind of lull period now. Of course, we do expect a bit of news flow over the next couple of weeks, but we are in this sort of lull period. So although we have this view that gilt yields should be higher, a bit similar to what Oriane was saying about being short France through the summer. It's not obvious to me that the summer might prove to be the right moment for gilt yields to rise to that target level that we have. And perhaps we'll be waiting towards the end of the summer, when once those policy priorities, what it means for borrowing, becomes a little bit more clear. But yeah, we're obviously, like everyone else, we're watching the headlines, but it doesn't feel like it's a theme driving markets at the moment.
And finally, on the UK side, Imogen, you talked last week about the leverage ratio framework. What was the news on that this week?
Yeah, I mean, the short answer is that we didn't really learn a lot, which is perhaps a little bit disappointing to those that had big expectations for a change in the framework. So to set the scene, the Bank of England announced in December that they would be reviewing the buffers as part of the leverage ratio framework, and that they would sort of come back to the market, if you like, come back to the financial system at this point in July with any results of that review. And actually what it has resulted in is a consultation on potential changes to those buffers. So it's not really new information. I guess in some ways it's sort of a step forwards. And we learn a bit more about the extent to which the buffers might be changed and how that might be impactful at very high level terms. It would potentially release some capital for banks. The reason that we care about this is because it could potentially encourage bank buying of gilts, which obviously would be important in an environment where we think one of the risks to gilts is that the government is potentially borrowing more, and particularly in an environment where the Bank of England is potentially making it harder, or at least more costly, for another big player in the gilt market, the leveraged participants, to buy gilts by introducing a haircut on gilt repo, as the FT reported last week. So this week's announcement felt a little bit like more of a kick of the can rather than anything meaningful, but it does feel like it's indicative of the change that is likely to come eventually. Question marks for me still remain, though, about how meaningful this could actually be in terms of bank demand for gilts. Freeing up capital doesn't automatically imply a kind of one-for-one increase in gilt purchases. Banks would be free to buy other things. They can buy other HQLA, high quality liquid assets, RMBS, covered bonds. And there's also banks that aren't currently leverage constrained in the UK that aren't already buying more gilts. So I don't know that it's necessarily the game changer that some people might be considering it to be. But of course, at the margin, it's helpful, but it's not helpful today. It's just, at least a couple of months down the line before we might see, some shoring up of demand from domestic players. But like I said, that could come at the expense of demand from other international players if the BOE is also going to announce rules around haircuts on gilt repo, which we don't have very much detail on yet. So I think just something to watch, a theme that we will return to plenty of times over the next couple of months. And just a reminder that if anyone did want to learn more about the leverage ratio framework or hear more from us on why it's important, why it matters, and what we think about it, please do listen to our recent episode of our new series on Bondcast, which is called Speaker's Corner, where we get kind of experts in the field on to deep dive into topics that matter on rates markets. And we did record one on the leverage ratio framework. Right, that's probably enough for today. There's lots going on, and I'm sure lots might have changed by the time we catch up next week. So thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out NatWest's other podcasts, Currency Exchange and Trade Links. Thanks. See you next week.